Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our indirect tax series entitled Export Controls, an overview of the China, Australia, Southeast Asia and US extraterritorial export control rules, requirements and best practices. My name is David Ware and I'm a tax partner based in our Deloitte Australia Melbourne office. I have the pleasure of hosting today's webcast. I have three speakers with me today: Suzanne Cao, Dolly Zhang, and Chen Van Wong. Suzanne is a tax principal based in Deloitte US McLean office who is actually about to commence a secondment to Deloitte Australia. Suzanne is Deloitte's Global Export Controls Leader, so welcome to Asia Pacific, Suzanne. Dolly is the partner who leads our China Global Trade Advisory practice. Dolly is based in our Shanghai office. Chen Van is a director in our Global Trade Advisory practice based in Singapore. Chen Van advises on international trade and customs matters, including export controls and sanctions. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Next slide, please. So our agenda today covers an overview of export controls in China, Australia, Southeast Asia, as well as US extraterritorial export control rules. We will talk through a case study as well to bring light to how the rules interact between countries, and we'll also provide an overview of best practice in export control compliance programs, as well as some common pitfalls. We'll then have a few minutes for questions at the end. Please feel free to type in any questions you have as they come to mind, and we'll endeavour to respond at the end, or if time does not permit, we'll be in touch with you following the debrief. Next slide, please. For those of you in the session who are not familiar with export controls, so export controls essentially regulate the export and supply of military and dual-use goods and technology. Dual-use goods are goods that have both civilian and potential military application. In our experience, the requirements that export controls place on businesses are often not known or clearly understood, and the ramifications of breaching the rules can be significant in terms of penalties and the potential impact on a nation's national security. As you can see on the slide in the cartoon, breaching export controls can result in significant penalties, including jail time, also damage to brand, and even prohibition from selling in a particular market. So without further ado, I have the pleasure of introducing Dolly Zhang from our China practice to speak about China's export controls regime. Dolly.
Thank you, David. For China, as you can see, over the past 12 months, there has been a lot of development regarding the China export control regime. First and foremost, on December the 1st, 2020, export control law in China came into force. It is the first law of export control in China. Its contents follows from the previous legislation and enforcement practice, while it also introduces major changes to the previous regime and introduced ideas such as the extra-territorial regime and also the deemed exports. China's export control law underscores the importance of export compliance program, as the China authority would consider the effectiveness of a company's program when granting expedited license approval for or general license for export control items. For companies, especially globally dispersed Chinese companies, may face compliance challenges if their products, software, or technologies to be shared abroad is subject to the control. Similarly, US and EU companies with operation in China may also find their China origin products to be controlled under the local regulations. As such, additional compliance measures and due diligence should be needed. In brief, the law includes 49 articles in 5 chapters, which will cover the general rule of the China export control regime, control policies, control lists, control measures, supervision and management, as well as the legal responsibilities and appendix. China's export control law defines export activities which is subject to control. In this case, it includes transfer of any controlled items out of China and the provision of any controlled items by any citizens, legal person, or non-corporate organization of China to any foreign organizations and individuals. Meanwhile, activities such as the transit, transshipment, re-export, and export from special customs regime or bounded supervision area are also fall under the control of the law. Next slide, please. China's previous export control measures are enforced on nuclear items, military items, and dual-use items for the purpose of nuclear, biological, chemical, and missiles. Here, the item refers to physical goods, technology, and service. Under the new export control law, it also covers the same. Here, the dual-use items refers to the items that can be used for both civil and military purpose, or they have the ability to improve military potential, especially those can be used for design, development, produce, or apply weapons or massive destruction. Nuclear items refers to the nuclear materials, equipment, and non-nuclear materials used for reactors or relevant technologies. Military items here refers to the facilities, special product equipment, technology, and service for military purpose. By following the catch-all principle, China's export control law also includes other relevant items as the controlled items. China authority could implement a temporary control on any goods, technology, or service not published in the control list for a period up to 2 years. Before the expiration, an assessment will be taken to make a decision on cancellation, extension, or inclusion of the temporary controlled items into the formal control lists. Next slide, please. As you can see, in general, the scope of controlled items are specified in various lists, which are subject to the adjustment from time to time. Items on the export control lists are subject to the license control requirement. Next slide, please. And here is a recent development. On April 28th, 2021, China's MOFCOM announced the guideline for export control internal compliance program for dual-use items. This guideline is an update to the previous one, which was issued back in 2007. The guideline has also attached a dual-use item export control compliance system guidance, which provide a comprehensive and operational reference for the establishment of each element mentioned in the guideline. And if you're looking at the structure, it is quite similar to the US BIS export control compliance guideline. The issuance of the guidance is based on the term 4 of Article 5 under the export control law. The state export control authority should publish export control guidance for relevant industries as appropriate to guide exporters in the establishment and improvement of their internal control compliance programs for export control. In addition to the compliance guidance attachment, the guidance also contains a lot of other information. The guidance clarifies that an internal control mechanism for export control shall follow three major principles, which is, firstly, it should be compliance and strictly abide by relevant national export control laws and regulation, should be independent, independently exists in the operation and management system within the company, and more importantly, effectiveness. This aims to encourage establishment of an effective mechanism and effectively play the role of supervision and control. According to the guidance, a compliance program should have 9 elements, which are listed in the program. According to the guideline, China's MOFCOM will also intensify to promote and encourage efforts on different aspects, which would include release of the compliance guidance to provide more detailed reference for China exporters. Based on its completeness level of internal control program, China authority will offer license facilitation or providing reference factors of reducing or mitigating administrative penalty to be imposed. Strengthen the information service from the government, including publish the laws and providing updates on domestic and foreign export control trends. Organize or encourage the departments and trade organizations to carry out training to the exporters on the export control regime. Assemble an export team which can provide consultancy services about the policies and regulations, as well as the internal control program, and organize different trainings and assessment on the effectiveness of internal compliance program. China's export control law encourages export operators to build an internal compliance programs. Exporters with healthy and effective control systems could be benefited from general license permission and other facilitation measures. A general license would allow the exporters of the same controlled items within a period of time to the same end users or different end users. Normally, a standard license can only be used for one time, but for this, it can be applied multiple times. Therefore, if the exporter, they export at big volume or quite frequently, this kind of benefit would save a lot of administration time and improve the efficiency of the supply chain. Next slide. So that brings us to the first polling question of the day. The question is, how does the new China export control law impact on your business? You have 5 options, which include you're impacted by the new law and either have made changes to the export control program, or you are in the middle of making changes. The new law have impacted your business, but you are taking a wait-and-see approach. You are still carrying out an assessment of the impact to the business and do not yet make any decision. And the new law does not impact your business at all.
Okay, while we're waiting for the results to come in, so Dolly, we learned that the new export control law specifically extends to organisations or individuals providing any agency services, shipping, delivery, customs clearance, or even third-party e-commerce trading platforms. Now, this appears to be much wider than the control regimes in the US and the EU, and certainly some of the jurisdictions here in Asia, where carve-outs are usually provided for things like transport services, financial services, insurance, etc. So I suppose, what are your thoughts on the rationale around the wider scope of controls in China?
Thank you, David. Indeed, China does have a wider coverage. Under the China export control law, any service activity that involves potential export control violation should be prohibited. We understand that the wider scope of control reflects China government's intention on the strong enforcement of the new law. It is worth noting that this rule is also applicable to the foreign organizations and individuals. However, in terms of how the foreign organization and individuals will be regulated, is still under the drafting, and we are looking forward to the more detailed rules in the near future.
Okay, thanks, Dolly. I can see some of the results of the polling question have come back in. I'm not sure if you'd like to comment on that, but it looks like the most are still carrying out an assessment to see if it impacts their business.
I think it is a very correct first step, because some companies, they are greatly affected and some are not. Therefore, a risk assessment will be the first step. And I'm sure Suzanne will share later the best practice. Thank you, David.
Thank you, Dolly. So next slide, please. So Australia's export controls regime, we'll move on to Australia now. So Australia's export control regime applies to the export, supply, publication and brokering of military and dual-use goods. Australia's export control regime, up until around 5 years ago, only covered the export of physical goods. But since then, export controls in Australia covers more than the export of physical goods. It also covers the intangible transmission of certain controlled technology or information. I've included some examples on the slide of transactions or instances where Australian export controls will apply to controlled goods or technology and a permit is required to export. So they cover the export, any export effectively, be it a sale, a supply, a return, a return for repair, export for a demonstration or a loan. So basically any export of controlled physical goods are covered. Additionally, supplying technology such as drawings in relation to controlled goods to a person outside Australia via email, or providing access to that controlled technology stored electronically is also covered, as is the publication of any controlled technologies. And brokering is also covered. So this is when a person acts as an agent of an intermediary in arranging the supply of goods and technology between two or more people and places located outside Australia. Next slide, please. So I've just outlined the situations in which Australian export controls apply. The question now is to what goods or technologies do these controls apply? To determine this, reference to the Defence and Strategic Goods list is required. So this list specifies the goods, software and technology that are controlled. To determine, so basically, and the list is split into two parts. Part one being military items and part two being dual-use items. So I've included a table on the slide which outlines the sections within each of those parts. The Defence and Strategic Goods list itself is long and complex. With dual-use goods in particular, it can sometimes be not straightforward to determine if your goods are in fact controlled, particularly when they are not sold with military applications in mind. So the permit system for Australian export controls is administered by the Defence Export Controls Office within the Department of Defence. On their website, you will find a Defence and Strategic Goods list self-assessment tool, which is quite handy to assist exporters with determining whether their goods are controlled. But it's important to note that if there's uncertainty as to whether the goods are in fact controlled, it is possible to apply for a Defence and Strategic Goods list assessment. And this is always advised in any instances of uncertainty, as you can gain certainty around the requirements for the exports of your goods or technology directly from the Defence Export Controls Office. One other important consideration to note is that it is possible for goods and technology not listed on the Defence and Strategic Goods list to be captured and controlled where such goods can be used in military or weapons of mass destruction program. So these are captured and controlled by catch-all controls within the legislation, and these are designed to cover circumstances where technology evolves quicker than the Defence and Strategic Goods list itself. Next slide, please. So applications to export controlled goods or technology can take various forms depending on the type of export. In some circumstances, it is possible to obtain a general export licence to remove the need to seek a permit for each and every export. Applications are assessed by the Defence Export Controls Office, and the assessment considers the type of goods or technology. It also considers the end use, the end user, as well as considerations across 5 broad categories, being regional security, international obligations, human rights, national security, and foreign policy considerations. It's important to note that only the Minister of Defence has the power to refuse an application to export. So in summary, for Australia, it's very important that businesses are aware of whether their goods and technologies, including intangible exports, as we mentioned, are subject to the Australian export control regime. Defence-related businesses are obviously covered, but those on the periphery of the controls need processes in place to consistently assess goods and technology prior to export. So an assessment of the applicability of the controls are undertaken, and if the goods are controlled, relevant permits are obtained. The penalties for breaching the rules are significant and include imprisonment, not to mention the brand damage that can also be caused. So with that, I will hand over to Chen Ven to speak about Southeast Asia.
Hi, good morning. Thank you, David. Okay, so now we're talking about Southeast Asia. So most of us, when talking about Southeast Asia, we are usually referring to the 10 countries making up ASEAN. So Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, Philippines, Singapore, Thailand, and Vietnam. Now, these countries are at vastly different stages of economic development, and their trade-related regulatory structures reflect this this difference. So nowhere is the difference more apparent than controls on the export of strategic goods. Next slide. Next slide, please. So most developing countries, especially those in the early stages of economic development, are usually focused on the regulation of imports. Now, controls on exports are then generally under different laws, like the chemical laws, hazardous materials, arms and munitions, telecom equipment, etc. However, as countries move up in the value chain, their industries and their exports become technologically more sophisticated, and exports, particularly of strategic items and technology, will become of greater concern. So in Southeast Asia, Singapore is the earliest adopter of strategic goods control. So in 2003, Singapore implemented the Strategic Goods Control Act. Now, after almost 20 years of continuous refinement and revision, Singapore's strategic goods regime is now quite matured. So any changes to Singapore's strategic goods regime is largely in relation to the control lists. Now, for Malaysia, is the next to enact its Strategic Trade Act in 2010, about 11 years ago. Malaysia then undertook, in my opinion, a very significant enhancement of the STA last year, that is in 2020, where it strengthened controls on the intangible technology transfer, or ITT. So now ITT controls are specifically factored into the ICP requirements, and there's a whole new section on ITT within the ICP requirements assessment. So even if companies, even if you do not have physical presence in Malaysia, but you are using data centers or servers based in Malaysia, you may potentially be covered under the STA ITT controls. So I suggest that companies, including those with existing STA licenses, you should review your operations in Malaysia to make sure that you are in compliance with the new ICP requirements. And as a word of caution, we understand that the Malaysian authorities are getting more aggressive in regard to STA enforcement. Now, moving on, the next ASEAN country to enact a comprehensive export control regime is the Philippines, which enacted its Strategic Trade Management Act, or STMA, in 2015. and issued the implementing rules and regulations to the STMA in 2017. So the Philippines started registering companies actually under the STMA last year in 2020, and issuance of licenses in stages started this year. I heard from sources that the Philippines authorities have been seriously preparing for the implementation of the STMA. They have received intensive training on ICP setup, assessments, and audits. So we suggest that if you have operations in the Philippines, please start looking and reviewing your operations there in relation to the new STMA. Then we come to Thailand, the latest ASEAN country to enact a comprehensive export control law. The Trade Controls on Weapons of Mass Destruction Act, which is implemented on 1st January 2020. However, I think actual implementation of the law has not yet started. Then we take a look at Indonesia and Philippines. Both these countries have not yet enacted a comprehensive export control law. Indonesia has been toying with strategic goods management for a long while now, but unfortunately, none of its agencies is prepared to take on the lead on this. As for Vietnam, it is still, I think, a long way from developing a comprehensive export control law. Controls on specific goods are covered under different laws. I understand that Vietnam is now revising its chemical laws, and for chemical businesses with operations in Vietnam, I think you may want to take a closer look at this new development. Now, then, let us take a closer look at some of the key elements of the 4 ASEAN countries' export control regimes. Next slide. A quick look. All 4 countries, Singapore, Malaysia, Philippines, and Thailand, all 4 countries are members of the Chemical Weapons Convention, the CWC, but not of the other international regimes. However, these 4 countries are implementing the same level of control as per these international regimes. Next slide. Then we look at the specific areas, the key elements of each of these 4 countries' regime. If you look at this table, Singapore is in terms of the licensing authority, Singapore is the only country which has designated its customs authority as the licensing authority. All the other 3 countries' licensing authorities are their respective commerce or trade ministry. So in terms of the control lists, all 4 countries' dual-use lists are largely based on the EU dual-use list. However, we note that only the Philippines has a 3rd list called the nationally controlled lists. So based on past experience, especially when we look at countries that are using adopting the EU list, the adoption of the list, the changes to the list occur at different times because of their domestic processes. So companies which operate in multiple ASEAN jurisdictions should be sensitive to the different timelines in the amendment of the controlled lists in the different countries, because this will affect whether or not certain items would fall under control in the different countries. Next slide, please. So when it comes to the scope of control, Singapore, Malaysia, and Thailand's scope of control are largely similar, covering export, re-export, transshipment, transit, brokering, and technology transfer. However, we note that the Philippines' scope of control is slightly broader. Besides the activities covered by the 3 other ASEAN countries, the Philippine Export Control Law also covers the import and provision of related services, such as brokering, financing, and transporting. So, in addition, all Filipino persons providing such services are also covered regardless of where they are located. So this is quite a big difference in terms of the Philippines regime. Then we come to the licensing requirements. So all countries have a registration and licensing system, and Singapore, Malaysia, and the Philippines provide per shipment permit as well as multiple shipment permits. The Philippines also provides for a general authorization for goods or services, which are provided to destination countries under specified conditions. So in summary, countries in Southeast Asia are at different stages of implementing controls on strategic goods, and businesses operating in multiple countries in the region should keep abreast of export control developments in each of these countries, and then build an effective internal compliance programs or adapt an enterprise-wide solution that would take the local laws and requirements into consideration. So otherwise, it would be quite complicated to have to deal with the different requirements in terms of controls on specific items in Southeast Asia. So over to you, David.
Thanks, Shenvan. We'll hand it over to Suzanne now to speak about the US export controls and how they can impact transactions in Asia Pacific. Suzanne.
Great. Thank you, David. So some of you may be wondering during this debrief as to why we're also discussing US export control regulations. Well, as many of you may know, that the US regulations are extraterritorial and that they apply outside the United States, which we will be discussing in more detail in a minute. The key U.S. regulations that oversee export controls and related trade sanctions are the U.S. Department of State Directorate of Defense Trade Controls, and they oversee the regulations of the International Traffic in Arms Regulations, also known as the ITAR, which control defense and military items and related services, data, and software. The U.S. Department of Commerce, a Bureau of Industry and Security that oversees the Export Administration Regulations, also known as the EAR, controls certain military items as well as dual-use items, which have commercial or defense applications. And the U.S. Department of Treasury, the Office of Foreign Assets Control, which oversees the trade and economic sanctions and embargoes over various different entities. Similar to other jurisdictions that we will cover today, U.S. export controls and sanctions regulations are in place to help drive regional security, address international obligations, such as human rights, as well as national security and foreign policy considerations. Next slide, please. As with other jurisdictional regimes discussed today, the U.S. export control laws and regulations capture hardware, software, data, and some services. Like the other regulations, the ITAR and the EAR have lists, similar to how Australia has its Part 1 and Part 2 of military items and dual-use items. Like the other regulations, the ITAR and EAR. Under the ITAR, there's the U.S. munitions list, also known as USML, and under the EAR, which is the commercial dual-use items, as well as some defense items, is the commodity control list, the CCL. These lists include these items that are subject to controls. Therefore, it's critical for companies to understand what their products are, how they were made, what's incorporated within, and where they're going, and with whom they're being shared. These pieces of information are necessary to understand whether the items are subject to the U.S. export controls and under which jurisdiction. What makes the U.S. regulations rather onerous is the fact that they are extraterritorial. These regulations apply to all U.S. persons, physical persons, as well as business entities, and various different organizations, all items in the United States, all non-U.S. made commodities that incorporate or are bundled with export controlled items, software, or technology, all non-U.S. made items are the direct product of U.S. technology, and even all non-U.S. made items that are the direct product of U.S. technology manufactured abroad. So moving on to the next one. These three sets of regulations are applied not just on U.S. entities and persons, but also non-U.S. entities and persons, because the regulations follow the item, the service, the data across borders. The ITAR and EAR apply to exports, re-exports, temporary imports, and transshipments. Additionally, they apply to non-U.S. persons and in the United States. So just to give an example, if there's an ITAR-controlled item, a defense article, that is shared with let's say, a Canadian person situated physically in the United States, this would be considered an actual export to Canada, which would require prior authorization to share to a Canadian, even though he or she may be physically located in the United States. So grappling with those types of considerations, it can be a challenge when you're a non-US organization that has to deal with these regulations. Moving on to the next slide. Reviewing a particular export transaction and whether it is subject to the US export control laws and regulations may require prior authorization from the US government in order to conduct the transaction. Typically, these authorizations take the form of an export authorization or a license, or an invocation of a license exception or license exemption. Exceptions are the terminology that's used by the Commerce Department and the EAR. Exemptions are the terminology that's used for the US Department of State under the ITAR. And in order to invoke these license exceptions or exemptions, there's various different requirements that are laid out in the organization, in the regulations, that you would have to satisfy before invoking it. For non-US persons and entities, because re-exports and re-transfers are captured under the US regulations, authorizations prior to re-exports and re-transfers are also required. So for example, if we had something exported from the US to Singapore, and then at that point, there was an authorization for that item to go to Singapore, if the Singapore entity then had to then ship it to France, they would need another authorization to cover that re-export, so from Singapore to France. Moving on to the next slide. The other thing companies need to consider is the fact that these regulations have teeth. As you have read in the newspapers over the last 5 to 6 years, or even most recently in the last year or two, the U.S. government has authority to apply fines and penalties on companies in the U.S. as well as non-U.S. based companies for violations of these export control laws and regulations, which can amount to multi-million dollars. And besides the fines and penalties, there are other consequences for non-compliance. Often companies which are fined are made public. So you can read about it on the various different government websites. Of course, it's in media and social media, and printed media. And so therefore, there's a potential reputational harm when these types of cases come about. For egregious violations, companies may also be barred from doing export activities or re-export activities. And similarly for individuals, for purposeful and violations, there's also the potential for imprisonment. You can see from the other regulations, and in China, they're also having the same type of teeth involved with fines and penalties and other kinds of consequences. And so therefore, you really need to pay attention to how these regulations may apply to your business. So not only are there the fines and penalties that are involved and the potential of prison, the U.S. government can also impose other requirements. So in significant cases, as you can easily read on, through the various different government websites, they may require from the government third-party audits on a periodic basis. It may require the addition of headcount or restructuring of an organization or removal of certain headcount. It also may require the implementation of IT solutions. So thinking about the cost of implementing an entire system in place, that can be quite costly. So all these other remedial measures, which could far exceed the monetary amounts of the actual fines and penalties. Moving on to the next slide. So with that background, some questions to consider of being a non-US based company when reviewing your potential transactions or your corporate makeup, or even how you're doing your research and development or your acquisition posture, is to see where this US nexus might come into play. So are there any US persons involved in the transaction? Keep in mind, again, the US person is physical persons as well as business entities and organizations. Are there any US financial institutions involved in the transaction? So thinking about the sanctions regime under the OFAC, if you're transacting in US dollars, there might be a potential issue as well, even if there's no other aspect of the transaction that might have US involvement. Are there any US origin considerations during export or re-export? Again, thinking about that the U.S. export control regulations may be triggered because of the use of technology that's been developed in the U.S., but then used by a non-U.S. entity to develop a final end product. That might be a trigger. And what are the U.S. export classification and licensing requirements? So as David and Dolly and also Chen Ben had mentioned, in those various different regulations, the understanding of how your product is classified and how it's controlled is going to be the also drive how the regulations apply to you, and also what requirements you might need to abide by. And has the U.S. item been incorporated or bundled? So that goes to the same thing as to thinking about your supply chain and where it's coming from, and whether you as a non-U.S. party involving U.S. suppliers, are you incorporating U.S. technology into your product? What are the local country rules of origin? So thinking about that and thinking about how most of your companies are multinational companies who have a footprint in a variety of different jurisdictions. So how do you align those? So that goes to the next thing of what are the local country export regulations for goods shipping in a local country. So Chen Ben mentioned, you're looking at Vietnam and Philippines and Thailand. You need to think about, okay, what else might apply to your transaction? And what are the destinations? So, thinking about what the local laws are going to be required to import these items, and then as well as if there's any need for re-export. So those are just some things to keep in mind, and I'll turn it over to David.
Thank you, Suzanne. So we now wanted to just cover a practical example. So in this example, so goods are manufactured in Singapore by a US multinational, utilising raw materials sourced from Australia and China. Technology or know-how is sourced from the company's US, China and Australian R&D centres. And the final product is considered a dual-use good by the Singapore authorities. So the question is, in which countries would this scenario raise export control requirements or issues? I might first ask Dolly just to comment from a China perspective.
Thank you, David. As the raw material, technology, and know-how are exported from China, it is necessary to check whether those goods, technologies, as well as any potential follow-up service, such as the after service, are subject to control. Unlike some other jurisdictions, China does not have a ECCN system. Therefore, the starting point will be the HS code and also the technical description of the goods, technology, and service to be exported. Thank you.
Thanks, Dolly. And Suzanne, what issues would that raise from a US perspective?
Sure. Examining the scenario, the fact that the technology and know-how could potentially be coming from one of the US R&D centers, the company would need to consider how this might trigger US export control laws. As we covered earlier, the US export control regulations control technology as well, and how it's used to create a foreign/non-US product. They still make the product subject to export control laws and regulations, even if there's no actual hardware being involved. So generally speaking, the company would need to consider and determine whether the export control classification of that technology rises to a level where there might need to be an authorization, or whether it will then subject the end product to U.S. export regulations, and then review whether the export of that particular item may be going. Because again, it's not just the exporting of it, but also who you're interacting with. So thinking about the multiple lists that are in existence from a screening perspective and know your customer type of perspective, there might be some sanction considerations as well as export considerations.
Okay, fantastic. And Chen Ben, for Singapore, what issues would this raise in Singapore?
In terms of Singapore, since the final goods are exported from Singapore, so first we need to determine if the goods are controlled under Singapore's strategic goods list. Then we will also need to see if there are any special restrictions in regard to the destination country, so where the goods will be exported to. And finally, we will then need to look at the license that's needed, whether the company will need to apply for an individual export license, or if the final good is already covered by an existing bulk license that the company has. So this is largely the three main areas that we have to look at for Singapore.
Great, great. And for Australia, an assessment of the raw materials that are to be exported, as well as the technology provided to the Singapore Company Office from the R&D Centre, would be needed to determine if either or both are covered by the Defence and Strategic Goods List. And even if they're not covered, you still need to turn your mind to whether the goods and technology are captured by the catch-all provisions as well. So as you can see, what starts as a reasonably simple and common transaction, all within the one US multinational, can raise export control requirements in many countries. And this is why it's important to have an export compliance program in place to ensure that such transactions are identified and reviewed prior to them happening. And as to how to do this most effectively, I'll hand over to Suzanne to speak about best practices in the area. Suzanne.
Thanks, David. So I thought we'd start off with a quick polling question just to sort of get the pulse of the audience today. Does your business have an export control management program in place? 1, yes, we have a comprehensive export control management program. 2, yes, although it's not comprehensive, as it only covers the export control requirements in a few countries. Or 3rd, no, we do not have a formal export control management program. And 4th, we don't know, or it's not applicable to us. So while we're waiting for those results to come in, perhaps we can ask a quick question to some of the other speakers as to how do companies that are multinationals handle the challenge of multiple jurisdictions? Chen Ven, maybe you want to take that one?
Yep. Well, we have worked with companies in the past, and many companies we see tend to apply their global compliance framework, which are usually based on the US or EU requirements, and apply them wholesale to their operations in other jurisdictions, including the ones in ASEAN. But this movement, this adoption, fails to take into account the local laws and the specific ICP and licensing requirements. So what we have seen is the more successful compliance programs are usually the ones which adapt from the existing internal compliance systems to meet the local requirements. So an enterprise-wide solution with localization is the more effective way to handle the challenges of across multiple jurisdictions.
Great. Thank you, Chen. So moving on to, we're going to really quickly go through some best practices, but looking at how the response right here, it's interesting to see that it's across the board, that different states of maturity, where to the highest percentage being that we're not really sure whether there's an export control management program, and then spraying it to different levels of completeness. So with that, let's turn to the next slide. We just wanted to highlight some of the elements of the Global Trade Compliance Program where we see as being some of the leading practices. And we typically look at these in 3 key buckets of people, process, and technology. When it comes to establishing an export compliance program, it's important to look at these 3 areas. 1, because the government regulators actually look at that, and Dolly had mentioned some of that as well as David. And then seeing about how effective it is. So people, you're thinking about your organizational structure and the tone from the top. So from the upper management and flowing through the organization, are they taking these types of regulations seriously? And then do you have individuals in your organization that have the correct knowledge base in order to help drive the program? And the ability to execute the requirements and the ability to evaluate and stop potential violations. I think Dolly had mentioned from China, the guidelines that there are the legality and the effectiveness and such, which goes along those lines. And then, of course, with training, making sure that the people throughout the organization are properly trained. And from a process perspective, along with having the right people, a number of people supporting the program, it's important to understand and be able to document what's being done, reevaluating what's being done on a periodic basis. So as programs are dynamic and not stagnant, they will change over time. Some examples of processes that are pretty standard to be documented are classification. So we understand that in all these different jurisdictions, the classification of a product or technology will drive certain requirements. Training of personnel, the export authorization determination, which is derived from the classification of an item. Screening, so knowing who you're conducting business activities with, and so know your customer, KYCs, and then also and then making sure that there's periodic risk assessments, evaluations, and audits. And having those documented, and then you're going to need to consider your organization and what is right for you. Some companies have very detailed processes and policies and procedures documented, while others are quite light. So it's not a one-size-fits-all. And then there's technology. With any modern-day program, there's some use of technology to help manage the overall program. Utilizing technology helps freeze up resources to focus on more critical tasks. So, for example, having a screening tool embedded into your systems allows for batch screening and record keeping without having to do screening manually. Other technologies, such as classification databases, where the classification information about a company's product or technology can be stored and will assist with the export authorization requirements, importing, exporting requirements, and other sort of related administrative documentation requirements and other compliance measures. Moving on to the next slide. So looking at the polling question and seeing how there are various different levels of development amongst the participants today, if you're starting from scratch, we always recommend that we take a look at the current state of the company, meaning let's see what you're doing, understand what regulations might apply to you and your operations. I think Dolly had mentioned, with China and the guidelines and everything, that there's also, you're starting from a risk assessment first to understand how does it all apply. Then we would want to understand what they have and what you have in place by way of compliance and what areas of risk there might be facing due to your current operations and your current business structure. Once we understand what a company is doing, what risks the company may be facing, then it's much easier for them to design a program. Oftentimes what we see is that companies who might not have a formal program actually are doing things correctly and are doing things, but it's not documented. So it's hard to make sure there's that consistency going forward as people change, as regulations change, as the business changes. And so that's something that we would want to look at. And with that, we start to assess what needs to be implemented. And as I said, right-size the program. So depending on whether you're a defense contractor, an aerospace, or if you're a life science company, or you're a commercial, consumer product company, there's going to be different aspects to your program, and different emphasis area points of your program because of the risk, because of how highly or not highly regulated your business might be. So always keeping in mind people, process, and technology. Regardless of what agency, that there are those common things in which regulators examine. So it's that tone from the top, written policies and procedures, being able to work independently and make certain difficult decisions with respect to whether to permit an export or not, making sure there's adequate staffing, and then to support the volume and complexity of your export activities. Moving to the next slide. So some other considerations to keep in mind revolve around the quality of your data and record keeping. So as you heard throughout this presentation, there is that element of understanding what it is that you have. What is it that your organization is doing? What kind of products it has? What kind of technology it has? And so therefore, making sure your master data is complete and the quality is correct is really critical. Because if you think of the saying, garbage in, garbage out, if you don't have the right information coming into your systems, then you're not going to have the right output. So that's really important, and which goes right into the product log. So making sure that all that information is captured somewhere and is being perpetually reviewed to make sure that it's accurate. And then with anything, just even from pure business sense, is making sure that any business activities that you have, you're conducting them with the right appropriate people, that you're permitted to do these transactions with the organization, with that particular country, or with that particular individual. Moving on to the next slide. And there are also just some practical considerations with all of these companies, all of your companies being multinational companies, whether you're headquartered in the US, headquartered in China, headquartered in Australia, headquartered in Thailand, wherever you might be, there are going to be things when you're thinking about a global program. So thinking about the language barriers, thinking about the multiple jurisdictions and the potential conflict of laws, and how do you resolve those issues. There's also a cultural thing, different aspects from business structure, from leadership structure and reporting structure that you have to take into consideration. And then also from a technical side, so thinking about the integration of disparate systems. So if your company is one that requires a lot of companies, thinking about how you're going to be able to get those integrated, how many different systems do you have, how good is the data in each of those systems, and how are you going to all work together to make sure that your program is comprehensive and that you're able to conduct the business in a smooth manner while in compliance with the applicable regulations. So I think those are just a few things that we want to highlight. I know we went through them quite quickly, but we wanted to save time for some questions. And so I think we're going to turn it to David, perhaps to MC the questions that have been coming in from our participants.
Sure. Thank you. Thank you, Suzanne. And thank you, Dolly and Chen Ven. So that brings to an end our today's discussion, but we do now have a couple of minutes available to respond to some of the questions that have come in from the audience. Maybe the first one for you, Dolly. For China, initially they used a HS code. Do they now have an export list or a separate classification methodology? You might be on mute, Dolly, perhaps. No? Maybe we'll skip that one. I can't quite hear you, Dolly. I'm not sure what's happened there. So maybe one for Chen Ven, and we'll see if we can get Dolly back. So are all ASEAN countries aligned with the EU export control list? Was one of the questions that came in.
Well, they are largely aligned with the EU list. Singapore and Malaysia certainly are adopting from the EU list. But as I mentioned earlier, these countries take from, especially when it comes to the amendments and additions to the list, Singapore and Malaysia adopt the list at different times because of domestic legislative processes. So even if there are certain changes to the EU list, it may not be immediately adopted in Singapore or Malaysia. There may be a time lag of a few months or even a few years before the amendments are adopted. So if you have operations, you should definitely, yes, you can base it off of the EU list, but we suggest that you should take a close look and check against the local lists to make sure that your goods are covered, because not all changes are adopted immediately. As for Thailand and the Philippines also have a third list of the national controlled list. So you should also check, make sure that your goods are not covered under a different list as well. And as for Thailand, we understand that there is apparently a self-certification list, which is based on the HS code. So you also would need to check against that list to make sure that your goods are not, whether to check whether your goods are actually covered or not.
Okay, great. And maybe we'll switch back to Dolly to see if your microphone's working. Dolly? No such luck. There are quite a few other questions that have come in. I know we're like 1 minute to the hour, so we will come back to anyone we haven't answered their question in the Q&A session within the next week or so. So we'll be in touch with anyone who's asked a question that we haven't been able to get to. So I'd just like to thank everyone for joining us today, and would like to encourage you to fill out the short survey that will pop up on the screen momentarily and tell us what you think about today's program. If you joined us late, please note the presentation will be archived for future viewing. If you feel that others would benefit from the webcast, please share the webcast via the Share This icon or have them visit the Debrief's website. As I mentioned, we'll respond to any questions that we haven't got to during the session. Also, if you think of any other questions or comments later, please feel free to reach out either to me or to our speakers, and we'll be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Global Mobility, Talent and Rewards series on 19 August, titled Southeast Asia in Focus, a look at COVID-19 tax relief measures and potential income tax audits. So from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.